Perpetuity, a term that might sound daunting at first, is actually a fascinating concept that holds significant importance in finance and investing. Imagine a stream of cash flows that goes on forever. Sounds almost magical, right? Yet, this idea is rooted in solid financial principles that can help you make informed investment decisions. So, let's dive into what perpetuity really means, how it originated, and why it matters in your financial journey. At its core, perpetuity refers to an annuity, or cash flow stream that continues indefinitely. Think of it as a reliable source of income that doesn't have an expiration date. This concept is particularly useful for valuing long term financial assets, where businesses expect it to generate cash flows forever. By estimating the present value of these infinite cash flows, investors can determine how much they would be willing to pay for an asset or business today. It's like peering into the future to assess the worth of something that keeps giving. Now, where did this term come from? The word perpetuity has its roots in the Latin word perpetuus, meaning continuing throughout. The idea of perpetual cash flows has been around since the 17th century when mathematicians and economists began developing formulas for valuing annuities and other financial instruments. Over time, perpetuity became a staple in finance, recognized for its utility in estimating the long-term value of assets and businesses. It's not just a financial term, it's a concept that has evolved through history and is now a key tool in investment analysis. So, how does perpetuity relate to accounting? Well, in the world of accounting, perpetuity is crucial for valuing long-term assets and liabilities. Think pensions, leases, and long-term debts. The fundamental idea here is that the value of these long-term obligations is determined by the present value of their future cash flows. For instance, when valuing pension obligations, accountants use perpetuity calculations to estimate the present value of future benefit payments. They consider the expected payments and the discount rate, which reflects the time value of money. This valuation is then recorded as a liability on the company's balance sheet. Let's look at some practical examples of perpetuity in action. Imagine you own a rental property generating $1,000 in monthly income, and you expect this income to continue indefinitely. To find out how much this property is worth today, you would use the perpetuity formula. Present value equals cash flow divided by the discount rate. If you determine an appropriate discount rate of 8%, the present value of your rental property would be $12,500. This calculation assumes that the rental income will keep rolling in forever, and that the discount rate accurately reflects the risk involved. Another example involves stocks. Suppose you own shares in a company that pays a perpetual annual dividend of $2 per share. With a discount rate of 5%, you can calculate the present value of your dividends as $40 per share. If you own 100 shares, that's a total value of $4,000. This straightforward calculation helps you assess whether the stock is overvalued or undervalued based on its dividend payments. Now, let's talk about bonds. Imagine you're evaluating a bond that pays a perpetual coupon of $100 per year with a discount rate of 8%. By applying the perpetuity formula, you find the present value to be $1,250. This means that the bond is trading at a premium because its coupon rate is higher than the discount rate. Understanding these calculations can empower you to make better investment choices. Perpetuities are not just limited to individual assets, they have broader applications in financial analysis and valuation. They can help value stocks, real estate, businesses, pension funds, and annuities. By estimating the present value of future cash flows, you can determine the fair value of these investments and make informed decisions about buying or selling. However, while perpetuities offer valuable insights, they also come with their own set of challenges. For instance, the assumption of perpetual growth can be unrealistic. Not all cash flows will continue indefinitely, and it's crucial to consider the long-term sustainability of the business or investment. Additionally, perpetuity valuations are sensitive to interest rate changes, inflation, and market volatility. It's essential to stay aware of these factors when using perpetuities in your financial analysis. Now, let's not forget the ethical considerations that come into play. Transparency is key. When valuing investments using perpetuities, it's essential to be open about the assumptions and methods used. Objectivity matters too. Avoid letting personal biases influence your analysis. And remember, accuracy is critical. Relying on solid data and sound financial principles will lead to better outcomes. In recent years, technological innovations and changes in financial regulation have also impacted the use of perpetuities. Advanced financial software and data analytics tools have made it easier to calculate and analyze perpetuities, increasing their accessibility. However, regulators are scrutinizing their use to prevent manipulation and ensure compliance. This evolving landscape means that investors need to stay informed and adapt their valuation methods accordingly. As we navigate the digital age, we face both challenges and opportunities with perpetuities. The rise of new investment vehicles, like cryptocurrencies, complicates traditional valuation methods. Yet, advancements in big data and analytics can enhance our understanding of cash flows and improve investment decisions. So, how can you, as an individual or business, benefit from a better understanding of perpetuities? First, it can lead to improved investment decisions. By grasping how perpetuities work, you can evaluate long term investments more effectively. Second, it enhances financial literacy, empowering you to make informed choices about your financial future. Third, it aids in financial planning, whether for retirement or other long term goals. To learn more about perpetuities, consider pursuing education and training programs, exploring online resources, or seeking advice from financial professionals. Financial modeling tools can also help you incorporate perpetuities into your decision making processes. Case studies and real world examples can provide valuable insights into their practical applications. In conclusion, perpetuity is a fundamental concept in finance that can significantly impact your financial analysis and decision making. By understanding its definition, practical applications, and potential pitfalls, you can better appreciate the long term value of investments and navigate the complexities of the financial world. Embrace the concept of perpetuity and let it guide you toward informed investment choices and a secure financial future.